You could have a 780 credit score and still get denied for mortgage. And it has nothing to do with your credit score. Lenders don't actually care as much about your credit score as you think they do. What kills 60% of mortgage applications isn't bad credit, it's something called debt-to-income ratio. And $40,000 in medical bills or collection accounts can destroy your DTI without moving your credit score a single point. I'm going to show you exactly how this trap works, how to calculate yours right now, and the strategy that actually fixes it. Pattern interrupt. Scenario, let's talk about Sarah. Sarah makes $85,000 a year. She has a credit score of 765. Perfect payment history for 7 years. She applies for $350,000 mortgage. Denied. The denial letter doesn't mention her credit score once. It says, debt-to-income ratio exceeds maximum threshold. Sarah has 3 things lenders are counting. 1. A car payment, $420 a month. 2. Student loans, $280 a month. 3. Medical debt and collections, $8,400 that she's been ignoring that medical debt. The lender is calculating it as a $180 per month obligation. Even though Sarah isn't paying it, that's the invisible killer. Here's the math. $420 plus $280 plus $180 equals $880 in monthly debt obligations. Divide that by her gross monthly income, $85,000 divided by 12 equals $7,083, and her DTI is 4% before the mortgage. Now add the mortgage payment. On a $350,000 loan at 7%, she'd be paying roughly $330 per month, principal, interest, taxes, insurance combined. New DTI, $880 plus $330 divided by $7,083 equals 2%. Most lenders want a max DTI of 43%. She's denied. Same exact person, same income, same job. Same credit score, but $8,400 in ignored medical debt just cost her the house. Pattern interrupt. Question. So here's what everyone gets wrong. You think DTI is just about money you're actively paying. It's not. Lenders count. 1. Auto loans, monthly payment. 2. Student loans, monthly payment, even if deferred. 3. Credit cards, they use 3-5% of your total balance, not just your minimum. 4. Medical collections, they estimate monthly payment as 5-2% of the balance. 5. Payday loans. 6. Personal loans. 7. Any debt appearing on your credit report, even accounts you're disputing, that last one is critical. A collection account you're fighting. Lenders still count it. Let me show you how to calculate your actual DTI right now. Pattern interrupt. Action. Grab a piece of paper or open your notes app. We're doing this live. Step 1. List every monthly debt obligation. Auto loan, write it down. Student loan minimum, write it down. Credit cards, take your total balance and multiply by 0.04, that's 4%, what most lenders use. Medical collections. Multiply the total balance by 0.02. Step 2. Add them all up. That's your total monthly debt. Step 3. Divide by your gross monthly income before taxes. That number, that's your current DTI. If it's above 36%, you're already in dangerous territory for mortgage approval. Above 43%, you're getting denied at most banks. Now here's where it gets interesting. Pattern interrupt strategy. Most people think they need to increase their income to fix DTI. Wrong. You have 3 levers. Lever 1. Eliminate debts entirely. Not just pay them down, eliminate them. Every $300 in monthly debt eliminated raises your DTI capacity by $750 in mortgage approval at a 43% threshold. $1.8000 medical debt collection account could be worth $50,000 increase in home buying power. Lever 2. Dispute false or inaccurate debts. If that collection account is wrong, it should never have been counted. Pull your credit reports, check every single debt, dispute anything incorrect. You have 30 days to respond. Lever 3. Settle collection accounts before applying. This is counterintuitive, but hear me out. That $8,400 collection account in Sarah's name, if she negotiates a settlement for $3,000 and pays it off before applying for mortgage, it disappears from her DTI calculation entirely. Yes, it still shows on her credit report. No, lenders don't count paid-off collections in DTI. The math, instead of a $180/month phantom payment, she has 0. That's a 45-point DTI improvement without touching her income. Pattern interrupt. Warning before you call your mortgage broker, understand this. They don't usually mention DTI because they make money on volume, not on preventing denials. And they certainly aren't going to tell you to spend 3 months cleaning up debt before applying. That costs them time. But here's the truth. Spending 90 days eliminating or settling collection accounts could mean the difference between a $350,000 approval and a $400,000 approval. That's $50,000 in home buying power. On a 30-year mortgage, that could be your dream house instead of starter apartment. Pattern interrupt. Real example. Mark applied for mortgage with 42.1% DTI, denied. He had $14,000 in medical collections. He spent 8 weeks. 1. Negotiating settlements on $10,000 of it. $4,000 paid. 2. Disputing $2,000 of inaccurate debt. 3. Paying off a $1,800 personal loan. New DTI 38.2%. Approved for $380,000. That strategy cost him $4,000 and took 2 months. It saved him from renting for another 2 years and got him $380,000 in equity. Your move right now. 1. Pull your credit report from Annual Credit Report. The only free one that matters. 2. Calculate your DTI using the formula I showed you. 3. If you're above 40%, start eliminating debt strategically before you talk to lenders. 4. If you're below 30%, you're in a strong position. The mortgage industry doesn't want you knowing this, because a homebuyer who understands DTI is a homebuyer who makes better decisions.